Yes, we're still waiting for others to join. So that's why I'm not saying anything. Good evening, everyone. Welcome
And
to today's
Good evening.
good evening, ma.
meeting.
Everyone.
Yeah, so please, if your camera is on, kindly help us turn it off, and please ensure your mic is muted throughout the class. And if at any point you have any question, just kindly use the raising and function, and I would give you the permission to speak so that our class will not be rowdy. Mr. Emmanuel, yeah, thank you. So let's just hold on for others to join. Then I'll drop the YouTube link for others. Then we'll start our class. Yes, so let's confirm you can see my screen. Let's use our emoji to confirm you can see my screen. You don't have to unmute your mic to do that. All right, thank you. Thank you, everyone. So yeah, we spent more than enough time on cash flow, right? So, and the reason why I had to do that is because I wanted us to just understand it very well, since it's actually one of those core topics that they usually test. So that's why we have to like spend that much time on it. So I'm just going to like walk you through. It's nothing really much to do. I've shared the solution. So just for you to look at it yourself. Yeah, so that's all about cash flow. And if you have any question at all, remember what I said before we started the class. If you're having issue, challenge with how you want to treat either accrued or any of those line items, just go back to the theory part, read it and understand it, right? If you understand it very well, you understand the why behind every addition and subtraction, then you would not have any problem solving any question they bring from cash flow, regardless of how the question was presented. So basically, what I just want to show you is what we were explaining, right? That regardless of whether you are using direct or indirect methods, your cash flow from operating activities would always be the same, right? So this is what we got using the indirect method, and it's the same thing that we got using our direct method. So regardless of the method you're using, the cash flow from operating activities will always be the same, right? So as for the other two segments, nothing is changing. So what me I just did, I didn't even do any other thing. I just copied what we have here and pasted it there. So same thing under an exam situation. Should you be asked to use one question to solve the other, the only place you worry about is your operating activities. Once you've done operating activities, all you need to do is whatever you have done using the direct method for the two other segments, just copy it down and you are done with cash flow. So yeah, so that is just everything about cash flow. For indirect method, we've explained everything about it, so I don't have to like go over it again, right? These are depreciation. As you know, depreciation is non-cash item, so that is why it's been added, and this figure was given to us in our question, right? The profit on disposal, right, is being reduced from here. Why? Because it was added before, so that is why we have to remove it to get an actual cash movement. The dividend received, we are removing it from operating activities because it's like another income, right? It has been added as part of other income in your income statement, and dividend received is to be presented under our investing activities, right? So that is why we are deducting it from here so that we can take it to where it's meant to be, which is our investing activities, right? The finance cost, we are adding it back, right? So that we'll be able to know the actual cash that was generated from operation before we deduct it, right? And in some cases, the finance cost in the income statement is usually not fully cash, right? It might actually be a combination of cash and accrual. So for that reason, there will be an adjustment. But for this particular question, the finance cost is the same thing, but regardless, you add it back first and remove it at the end when you're done before you arrive at your net cash flow from operation. And for the working capital adjustment, it's just you comparing what you have as opening and closing on your income statement, right? And I told you that that place basically deals with your current asset and current liability. So what I just basically do is, okay, what's the inventory at the beginning of the period? 120. What's the inventory at the end? 295. Did it increase or it decrease? It's increased. And if it's increased, what are we doing? We are lessing. Why? Because we bought more inventory. And buying more inventory means that money has actually flowed, right? uh So so that is why we're just taking the difference. So that difference is showing us the actual cash that was paid out within that period. So same thing applies to your receivable, trade payable, accrued expenses, and every other um current asset or liability that you were given, except for your bank and your overdraft. Yeah. So that is just pretty much everything about cash flow, right? So what I wrote here is still the same thing that I mentioned earlier. So regardless of the method, your cash flow generated from operating activities will always be the same, right? And the difference between indirect method and direct method is your operating activities. Yeah, so that's that about cash flow statement. So let's move forward. Please, have we done a practical question? Yes. Yes. The question we solved before was just on May 2024, right? We solved it using the direct method, right? And I did this in direct method, which is what I just explained. So it's left for you now to solve as many questions as possible, right? Regardless of the number of courses you're taking, if you know that you've already understood this cash flow, just don't leave it. At least in a week, try to solve at least one question on cash flow. The more question you solve, the more you would understand the different ways that the questions can be presented, right? As you are solving it, you are running into challenge, you are coming to ask question, and when you get answers to those questions, you tend to learn and understand more, right? So the remaining one is just for you to practice as more questions as possible. And should you have any challenge, that would, I think, is actually your network, right? I hope you can all hear me. Okay.
We can hear you.
Okay. Then I think is your network. Is your network. I can't hear anything, please. Yes, I'm presenting. It's probably your network. You can just like go off and join back again. Yeah, thank you. So that is just it to practice as more question as possible. I want you guys to model cash flow. If you see it, just model it for me. So let's move forward. So this week we are diving into a new topic, which is basically financial statements analysis. So that's what we are going into. And the what is it called? The method is still the same, right? Regardless of any topic you're doing, everything boils down to your understanding of the topic, right? When there's a ratio analysis, a lot of people tend to fidget because they'll be like, how do I interpret this ratio? To interpret ratio very well, the very first thing is for you to understand those components that makes up the formula for any of the ratios that you are calculating, right? Once you know that, okay, to calculate this I need my gross profit, I need what is it called, probably your non-current assets also, then your interpretation should fall within those elements, right? That means whether that particular ratio is either high or low, it's all dependent on those things that make up the formula, right? So you can now relate it. Okay, this reduction is this might be as a result of probably purchase of asset clinical, but as we dive in deeper you would understand where I'm going to. So these basically it, right? So these are the things I will be going through. Hopefully I pray we are able to finish it. If we're not able to finish it, when next we'll meet, we'll just solve the question together before we move to the next topic. But this would not take more than two, let me just say 1.5 class, ja. So that is it. So we are going to be looking at the purpose of ratio. So for every topic you're reading, right, whether it has calculation or not, for you to be on the safer side, what I usually do is read the theory part very well. Should they bring out the theory question instead of the calculation, you know that that one is like bonus mark for you. You just use it to brush it before you start the main thing. So that is what I used to do. So for ratio, you might want to understand the what is it called, purpose of financial analysis. You want to know the limitations, right? Because sometimes they ask this limitation a lot. So any theory at all that just pop up, just shoot that one first. So that should they by mistake bring out that theory, you know that this one is just bonus mark for me. And no mark is small when it comes to exam. So these are basically everything we are going to be looking at in the course of our discussion, right? They said this is the learning goal. You have to go through this. After we are done with this chapter, these are the things that you are expected to know or things that you are expected to be able to do after going through everything, and hopefully we would achieve that. Yeah, so this is financial statement analysis. They are just trying to like give like a definition of what financial statement analysis mean. And before then, as you can see here, they say there is no definite definition. There is no single definition, right, to what financial statement analysis mean, because it actually means different things to different people. Yeah. So according to what we have here, they say is the process of understanding the risk and profitability of a firm through analysis of reported financial information by using different accounting tools and techniques. So basically, the summary is you just trying to understand those numbers, right? Simply put, you have your income statement, you have your what is it called, your statement of financial position. Those are just numbers looking at you. What you can't just make what is it called, decision based on just those numbers. You need something to help you understand the different numbers, right, what they represent, and it helps you to also analyze the risk or profitability depend on what you are looking at, right? So that is what financial analysis basically means, just you looking at it in more detail, right, beyond just what has been presented, right? So, and as they said here, they say financial statements are used to make decisions, right? They are used by shareholders, investors, and all other users of financial statements, right? And just as I explained, there are a lot of figures in those financial statements, and those figures might actually be too cumbersome to comprehend. And the best way to bring this figure to to create like a summary of everything to make sense out of it is to analyze those figures and interpret it in a very plain language that those users would understand, right? So as it will aid their decision. So now the next thing is financial ratio can help. So we've actually talked about analysis. So the next thing is financial ratio is like one of those tools that is used for what is it called, financial statement analysis, right? And basically we're now looking at what those ratios can help the users to achieve. The very first thing here is help them to know the financial position of the entity, right? How is that achieved? For someone that is not an accountant, the person cannot just look at a balance sheet or statement of financial position, for example, and understand what it is all about, right? Someone needs to analyze and interpret those numbers in a very plain language so that they will be able to understand, right? And by doing so, you are helping the user to do what, to understand the position, financial position of the entity. Now, it also helps to understand the financial performance. When we're talking about financial performance, we are looking at our income statement. It helps us to know how we are doing, right? Beyond those numbers, beyond those numbers, because okay, income statement is even easier to understand because you can say, okay, oh, this is the revenue I'm making, this is my net profits, as despite that, some business owners still have problem understanding it. So financial ratio helps you to understand your financial position, the implication of it precisely, right? You might know that, okay, oh, this is my net profit, right? This is my net profit. And that does can alone cannot just help you to make decision. You need to understand the implication of those net profits that you have at every point in time, right? So the next thing is using financial ratio for comparison. Now, one basic use or major use of financial ratio is actually help people to understand the performance of business in comparison with other businesses, right? So when it comes to financial ratio, there are different ways that you can use it to, compare, to make that comparison, to see the performance of your business in comparison with other businesses. And the very first one is comparison over a number of years. By looking at the ratio of a company over a number of years, it might be possible to detect improvement or deterioration in the financial performance. So what they are just simply saying here is that you can use financial ratio to compare your own performance over the years. For example, what was my profitability ratio for 2024 in comparison with my 2025 performance, right? You tend to do that. You can do that for either 2 or more years to say, okay, oh, in 2022 I made this also amount, right? My ratio is this, and in 2023 now this is my ratio. What's the implication? Was there an increase or decrease in any of the ratio you are looking at, right? And what is the implication of that increase or decrease, right? So that is one way that financial ratio can be used to make comparison. The second way is comparison with similar ratio of other similar companies for the same period, right? You're into bakery, you can use your own ratio to compare with that of another bakery within the same period. Okay, oh, this also bakery, this is their performance for 2025. This is our own, right? Based on their financial statement, of course. Then you now compare the two to see how you are performing when it's in comparison to those people, either your competitors or just any other bakery that operates within that same period, right? Given the same economic situation. So that is another way that ratio can be used to carry out comparison. And they say in some cases, perhaps comparison with industry average. Now, this is what you should look out for. These three ways that ratio can be used to carry out comparison are the three different ways that your questions can actually come true, right? They can give you a question and ask you that, okay, oh, this also company, this is their performance, this is their financial statement for probably 2024 and two other years, right? And you are asked to calculate a ratio to compare their performance over those years. That is one. Secondly, they can give you the financial statements of two different companies and ask you to carry out comparison, right? To prepare their ratio or calculate the ratio, analyze it by comparing their financial position or performance depending on what they're asking you to do, or they can give you an industry average, right? Like if they will just tell you that, okay, oh, these are the financial ratio for this social industry, and they'll now ask you to calculate the ratio of any entity that was given to you. Then you now start comparing, okay, oh, for this year, this is the profitability ratio for our own organization, and you now compare it with that industry average that you were given to see, okay, oh, are we operating below the industry average, or we are still in line with it. So those are the different ways that your question can actually be presented. Now, having said that, the next thing is for us to look at the various categories of financial ratio. And these are the five major categories of financial ratio, right? Now, when we are going through this, your mind should always be there, because sometimes the question might actually not be straightforward as to the particular ratio they want you to calculate, right? So based on your understanding of these different categories of financial ratio and what they mean, right, in relation with the scenario that was painted, would now help you to decide which of the financial ratio would be suitable for whatever question that you have been presented with. I hope we are together. Okay, thank you.
Yeah.
I wanted to confirm that. Okay, thank you. Let me go back. Yeah, so you need to understand financial performance. What is it looking at, right? So by the time they paint one scenario, this and that, this person doesn't know, you should just know that this is what they are looking for. So that is why it is important that you understand what each of these mean, right? It's not about you just diving into um cramming those formulas. Is about you understanding what each of these stand for, and that will help you with your analysis and interpretation. You would not There will be no need for you to crack your brain too much to do it if you understand um each of these, right? So all this one is just grammar. By now we all know what general financial statement is, and this is them still breaking down different users of financial statements, right? We already know who those people are. They are the people that make use of the financial statements, right? So investors, they do make use of it. The lender, employee, and every other stakeholders make use of the financial statements, right? So the reason why they basically brought this, if you remember what we mentioned earlier, is that the financial ratio helps those users of financial statements, right, to understand the financial position of that business as well as the financial performance of the business. So that's why they have to outline that for you to understand it, right? And they are still breaking it down further, right? So I'm just going to look at two and we'll move forward, so we'll not waste time on this. They said a private investor needs to know whether to continue to hold shares or to sell them. He will then tend to be most interested in profitability ratio, such as gross and net profit margin, right? So this is them just telling you what to expect. By the time they paint one scenario that somebody wants to invest in this social company, kiniko, from there you should know that for you just have to like put yourself in the shoes of those investors. If you are the one that wants to invest in a company, what are those things that you look out for? What are those things that you would most likely be interested in knowing about that company before you take a dive, right? So, and when you talk about that, the very first thing that comes to mind is what? Profitability ratio. You definitely want to check those profitability ratio to know how the business has been performing. Then also you might also want to know the earning per share, dividends cover, and all those equity related ratio, right? So those are the things that you want to know. Then the next one is potential acquirer need information about entity's profitability. For example, they paint a scenario that this also company wants to purchase or acquire this social company, right? And they want to like get more information about. So by the time they paint it, first thing that comes to mind is what? As an entity that wants to merge, right, or purchase another entity, the very first thing is what's the profitability. So profitability sort of come up in almost everything you're doing except for few situations, right? So the first thing that comes to mind is how profitable is this entity that I want to dive into, right? How profitable is it? And you also look at their working capital and other things so that it won't be like you're just buying over a liability, right? So you can look at others, right? So we'll not waste time on this. It's just basically them trying to explain how all these users of accounting, right, of accounting information would um use ratio, right? So just try and read everything, right? Try and read it. It will help you to understand better. To understand all those their scenario, they can pick one thing from here and develop it into one big scenario that will scare somebody, but you not be scared. Yeah. So we are basically looking at all these different categories of ratios, right? To take them one after the other. The very first one here is return on capital. Return on capital. I'm coming. I want to check under which category this falls. No understand this their part sef. I'm coming. Okay. Give me a minute. Oh. Okay. They didn't break it into this different heading, but I'll look for a material that did that just for clarity's sake, for you to be able to know the different ratios that fall under each of these categories, right? So, but just as they highlighted here, this return on capital falls under financial performance, right? Um, then we have the profitability or use of assets. So those are like the three major sub topic or subheading under this financial ratio. And I think that's what they are doing here. That's what they are doing here. So let's go on. So the very first ratio is your return on capital, right? Profitability and assets ratio. So these three ratios fall under your financial performance, but yeah, falls under your financial performance ratio. Now, they say the aim of profitability ratio is to assess the financial performance of a profit-making entity and the return that it makes on capital investment. You're just trying to check, oh, okay, oh, the capital that was invested in this company, how much is the return, right? Or what's the ratio of the return that was made from this capital? So that is basically what you are looking at. So the first thing to look at is your return on capital employed. What is that return that you're gaining from the capital that you employ, or the capital that you put into the business? So there's a profit-making company should try to make profit that is large enough in relation to amounts invested, right? So from here itself, you should be able to know how to analyze this statement. Just as I mentioned earlier, when it comes to ratio interpretation, the first thing to come to your mind is the element that makes up that ratio you are calculating. Now, what are we using here? The topic is the formula is what? Profit before interest and taxation, right? And you're looking at what? Your capital employed, all over the capital employed, right? So these are the capital employed, and it deals with those equity side, right? Your share capital plus reserve. I think non-current liability, but yeah. So those are just this is your capital employed. So this is what makes up your capital employed. So now if we calculate this our return on capital employed and want to interpret it whether it's high or low, you will now consider what are those things that make up your profit before tax, right? Then you start looking at it one after the other. Okay, oh, in this year, right, our operating expenses increase in comparison with, right? So you can just simply say that okay, oh, the return on capital employed increase or decrease as a result of what? You look at those things that was considered before they arrive at the profit before interest and tax, right? And what are those things? We have revenue, right? We have our cost of sales, we have operating expenses, we have finance costs. So you're looking at those line items, right, that was considered before arriving at the profit um before interest and tax. So an increase or decrease in any of those line items would lead to an increase or decrease in your return on capital employed, right? So if you say that okay, oh, your return on capital employed reduced this year, that is the first statement. As a result of, you now start linking it back. Okay, oh, let's say as a result of reduction in revenue or increase in what is it called? Increase in your operating expenses or any of those things. But what I just want you to know is for any of the ratio you are using, try to link it to the thing that makes up the capital, the formula, and that will make your interpretation a lot more easier. You don't have to like crack your brain too much, right? You don't have to crack your brain too much to get what you want. So there's a capital employed is the share capital, reserve plus long-term debt capital such as bank loan. So those are the things that make up your capital. You know, we are talking about capital, we are talking about that equity part of your SFP, right? They say where possible, use the average capital employed during the year. This is usually the average of the capital employed at the beginning and at the end. So you can either add all these things together or use the average, whichever is easier for you. Just do it so that you not confuse yourself. So let's see what they have to tell us, right? They say return on capital employed. The following figure relates to company S year one and year two. So this one we are comparing the same company's performance in two different years, right? So this is January year one and this is December year one, right? They have the profit before tax, right? And profit after tax. So now to calculate our ROIs, interest charge on bank were 30,000. So okay, I'm coming. I think someone just dropped a message for me. Let me check it. Screen isn't sharing. The screen is sharing, no. Probably your network. Yes, my screen is showing. Is your network? Just log off and join back again. Sorry. Do you have any questions so far before I move forward? The voice is cracking. Most likely my network or your network rather. As if my network is better this night.
Your voice
Yes.
is not tracking, ma'am. Maybe it's the person's network.
Okay, okay. Thank you. Lavender, what's your question?
Okay, ma. Thank you for this particular financial ratios that you've started explaining. I just want
Mm-hmm.
to ask because um, a company is currently trying to pitch to investors
Mm-hmm.
on to come in and invest with the company. And the company is less than 1 year old. They started
Mhm.
since February. Now, when the financial statement from January up to the period ended 31st of August 2025 is prepared, are they
Mhm.
still going to have to do a financial ratio to assess the profitability of the company? Because from what you've explained, you're talking about comparing years.
It's not just when it comes to ratio, it's not just about you comparing years, right? You can also compare like monthly performance if you have those data presented on monthly basis so that you see your performance month on month. Are you growing, right? How is your performance? Are you performing well or not? So that comparison can also be done across months.
Okay, so the return on capital employed, just like you're explaining now, that requires the what is it called? The capital, share capital, and all of that. How do we use that to measure by month?
Okay, you know that your balance sheet item, they are carried forward, right? Like any figures that you have on your balance sheet represent the current value of either the asset or liability that you have at that time.
Okay, now the challenge, okay, for this, okay, maybe for a business with complete record. So for a business without
Exactly.
a complete record, what alternative do they have?
Ah, I really don't know, to be honest. But when
That's
you
it,
say
because
a,
that's my
business.
current situation in my company I'm working for, and I'm just 3 months old with the company. So I started working with incomplete records. I just finished preparing a financial statement for a potential investor they are planning to pitch deck with. So seeing this topic today makes me want to really clear some things, because it was really a big task for me. In fact, this is my first time preparing a financial statement from incomplete records, just joining the company. So it was really a tedious one for me. So I'm just
Yeah.
trying to know what alternatives I can use when it comes to financial ratios for this, because I've not even gotten to that part yet.
Okay.
Yes, I
Mm,
just finished working out the financial statements from the complete records, the available data they supplied me. Yes, so that's
but,
what I'm
but
trying
but
to do.
based on that available data that you have, right? You are able to prepare an income statement and you have a balance sheet, right?
A comprehensive one. The only month-on-month um, metrics I was able to gather was that of revenue. That is because from the back end of their app database, I was able to extract, clean, and get out the revenue up to gross profit margin. But talking about anything outside that, it
Mm,
has been a difficult thing.
so
So
so what you do is the record you have complete is the one you are going to do ratio for, if at all there is need for it, right? If you say your income statement is okay and everything is fine, then you just focus on using that.
okay, all
Yeah,
right.
exactly. Thank you. Any other question before we move forward?
Hello, Jamila.
Yeah, I can hear you. Good evening.
Yeah, good evening. I think I have an addition to what she just explained. First of
Mm.
all, ratios and statement of financial position has its own inefficiencies because they
Yeah,
actually don't show true. They actually don't show true value of a company.
yeah, yes.
So, what I would advise, because for you not to have a complete statement of account for a year, I don't think it will show a true fair value of a company or the strength of the company. Because if you want to look at it critically, for a company to be 1 year, it shows that I think they don't even have an experience of
Mm.
whatever sector they are doing business in. That's one is already an hiccup when you are
Mm.
analyzing a company to knowing its strength. So I would just advise she should work on maybe the management accounts, the payments and the revenues for that year, maybe within 6 months, to have an
Yeah,
idea of what the company is doing. And
yeah.
also to check the management team of the company if they have the wherewithal of what sector they are playing in. Thank you.
Thank you so much for your contribution. Yeah, I hope you got that, Lavender. All right, thank you. Yeah, so let's continue. Let's continue. Yeah, so this is where we stop, right? So these are the information that we're giving for year one and year two. So we've been giving this. So what this means is that if we are looking at our capital employed, this is what we'll be considering, right? Yeah, that's what we'll be considering. Okay, so these are profit before tax, right? This is income tax and profit after tax. Remember, based on the formula, um we're making use of profits before interest and tax, right? So but whenever you are giving only profit after tax, right, and you have your tax, just simply you adding back depend on what you're giving, but basically this is what we need, this to 10 interest charge on bank loan, right? So they gave us this as well. So they say your return on capital employed is calculated as 240. What's the 240 for? Right? They're adding back interest. They're adding back interest, right? That's because the formula says what? Profits before interest and taxation. And the income statement or summary that we're giving here is only showing your profit before tax, right? It's only showing your profit before tax. What's this one now? It's only showing your profit before tax, which means that this interest must have been deducted before they even got this, right? Must have been deducted before they got this. So there is need for you to add it back so that you have your profits before interest and tax, right? But if you're giving income statements where your what is it called, finance cost and your income tax is highlighted, right, very clearly separately, then you don't have to do this hardback. It's because of the way it was presented. So how your question is presented will determine what you do. So just note that. So that's why they had to go back to do this before arriving at what is it called, the 240 that they use, which is the profit before interest and tax. Now divided by 1,200,000. Now there have to be a working for them to get the capital employed. So what did they do? Remember they told us earlier that if we have information of two periods, right, that we can decide to use like beginning and the ending. This is more like saying this is your the value of these things at the beginning of the year, more like opening, right? And this is the one at the closing. Remember, they made one statement earlier that we can choose to use the average, right? The average of capital employed at the beginning and at the end of the year. So that is just simply what they did here. And to get average, what do? You add what you have at the beginning to what you have at the end divided by 2 to get the average. And that's simply what they did here. So your return on capital, what is it called, employee is 20%. Now this is how ratio work. You just have 20%. This 20% does not make any sense at all. Why? Because you can't just say, okay, return on capital and this thing is 20% alone. It does not really help you to make more information or more decision, right? Compared to when you have probably two different years data and you are comparing it to be, okay, this year own is 20%, that the following year's own is 30%. Was there an increase or decrease? Then from there you begin to speak all the grammar you want, right? So but this is just it. So let's move forward and see what they wrote. They say this return on capital employed figure can be compared with the return on capital employed achieved by the company in the previous years, right? That is just what I said. Saying something is 20% does not really make more meaning. Like you comparing, okay, this was what we have in the previous year. This is what we have now. Was there an increase or decrease? And if there is either an increase or decrease, what are you now looking at? You look at your profit, right? Profits before tax, right? Okay, this increase or decrease I'm having is likely as a result of, that is in situation where you are giving like a full statement that you can see the items, right? the calculation that was done before arriving at this. You can just compare those line items to see, okay, like those key ones, key things like revenue, cost of sales, operating expenses. You just look at it, right, to see the increase that just the flow within those items, and that would now help you to link your increase or decrease to either the increase or decrease in all those line items. Same thing applies to your working capital. Did it increase or decrease, right? So an increase or decrease in any of these would also affect your return on capital employed, what is it called, ratio, right? So that is just basically how you interpret, link those items that makes up your formula to what you got. So that is just basically it. And if you do it like that, you don't have to crack your brain much to do that. So this one is just simply them telling you how you're going to calculate your return on capital employed for a group. Should they give you like a financial information of a group and they ask you to calculate the return on capital employed? So this is just simply how you're going to get it, right? They say to calculate the roles for group companies, it is necessary to decide what to do with non-controlling interest, that is the minority interest, since capital employed includes all the debt capital in the group. It makes sense to include the non-controlling interest in the capital employed. So ROE should therefore be measured as profit before interest and tax as a proportion of total capital employed, including non-controlling interest. So what they are just telling you now is they are not trying to confuse you. It's still the same thing. So what they are just simply saying is your capital employed, right, includes that part that belongs to non-controlling interest. And if you have to calculate the roles for group, what simply put, what I just saying is you are going to include that non-controlling interest as part of your what is it called, capital employed, to be used to calculate your return on capital employed. So that just basically it, right? Now the next ratio we'll look at is return on shareholders capital. Now if someone wants to like invest in a company, right, the first thing is they will want to calculate the return on capital employed for that company for what is it called, for a period of time, right? That would help to give them insight on possibly what they would likely to gain too, right? Then the next thing is they would want to also check the return on shareholders capital for a number of years to know that, okay, the existing shareholders, what's the return that they are making or gaining currently, right? Then from there they'll be able to make their decision. So just understand these things. As the scenario is coming, link it to it and just calculate whatever you can and just give them. So they say the return on shareholders measures the return on investment that shareholders of the company have made. Those are the existing shareholders. This ratio normally uses the value of shareholders' investment as shown in the statement of financial position rather than the market value of the shares. So what I'm just saying is, whenever, sorry, please can you mute your mic? Who is that person? Fikayo Samson. Please help us mute your mic. Thank you. Can you hear me? So you just look at it helps you. They say it chooses the value of the shareholders' investment in the financial position. So you are just simply looking at those investment that was made by your shareholder, the one that was given to you in your SUFP. So if they want to confuse you now, because of this single statement that they made here, right, they might show you what is in the financial position and still give you um what is it called, bullet to say that, okay, the market value of that share is this. Then you now start thinking that which one will I use? So they just told you here to stick to the one that was presented on your financial position. So even when they made mention of market value or not, that one does not concern you. Just close your eye. and move forward. So now this is the formula for calculating your return on shareholders capital, your profits after taxation and preference dividends, right? Profit after taxation. Remember, this is different from the one we used earlier, right? The one before was profits before, but this is profits after taxation, which means that if you were given profit before, you have to remove your taxation to get this, right? And if there's any information about preference dividends, you still have to remove that one before you get this one. And this is your share capital and reserve, right? So now the same way and the same explanation I gave for return on capital employed is the same thing that applies to this. When you calculate it, there is increase or decrease. So what are the things that make up the formula? We have profit after tax. What are those things that were considered before the profit after tax was achieved? So those things are what will either lead to the increase or decrease in this particular ratio. And that is how you'll be able to link your answer to the cost, right? This has reduced as a result of this, right? So that is how you'll be able to link it. So let's move forward. They say the average value of share
I'm sorry,
capital.
I have a question. Sorry.
Okay, go ahead
When
with your
they
question.
say when they say profit after tax and preference share, does it mean I'll get my profit after tax then minus it from preference share, or profit after tax plus preference share?
When I say profit after tax, let me see. I'm coming. Give me a minute. They said profit after tax and preference dividends. So let's look at the calculation, then we'll both understand it better. Let's look at the figure and see what they do. Did they add it or did they remove it? So that's where we are going. Okay, so just hold on. We are getting there so that we will not skip anything at all. So they say the average value of share capital should be used, right? The average should be used if you're giving the information, right? If you're not giving, just use what you have. They say this is the average of share capital at the beginning, at the end. So if what you are giving is not at the beginning of, and at the end, just use the figure you have. Don't bother yourself about average, right? Average comes into play when you have two or more data that you want to just like take the average of, right? But if it's just one that you were giving, focus on that one and forget about average. But if possible, that is why they use if possible here. Use the average share capital. They say profit after tax is used as the most suitable measure of return for the shareholder, since this is a measure of earnings, right? Available for payment as dividends or for reinvestment in the business. So that is why they use profit after tax, right? Because it is this profit that would be shared as dividends to investors or the owners of the shareholders, right? So that's why they use profit after tax, right, for this particular calculation. Now, so let's dive in and see whether we are adding our preference dividends or not. I'm coming. Did I even give any information about that here? They didn't. I'm coming. Okay. They didn't. So in situation where they didn't show it like that. They say profit after tax and preference dividends, right? So what it means is that you're adding your preference dividends to your profit after tax, right? Then you divide it with your share capital. Although I'll look for equations that have this just for clarity's sake. I'll look for equations that have preferred dividends in it so that it will be clear whether it will be added or not. But as for this particular place, it is not clear, right? So I'll look for a question that has this one just for us to see how it actually works when it comes to the figures. But when they say and usually means adding, right? And
Alright.
usually
Good evening. I think when they say profit after tax and preference dividend, that should be the profit after you've deducted tax and you've paid dividends to preference
Hopefully.
shareholders.
Okay, okay. So that's it. I think that makes sense actually. That makes sense. So it's even the preference shareholders that are usually settled first before every other ones, Abby. So that makes sense. Yeah. So let's move forward. So this is the question that we're giving. We're giving the question for the beginning of the period and for the
Evening,
end
ma.
of the sorry, good evening.
Sorry, can that man repeat what he said? I didn't hear him.
What he said is when they say profit after tax and preferred dividends. So what it simply means is that you're going to use the profits after tax, right? Minus your preferred dividends. If the question you're being given has preference dividends in it, you remove it. So whatever figure you have is what you are using.
All right, all right.
Please,
Thank you.
for anyone that would have question going forward, simply just raise your hand so that I can unmute you. Simply raise your hand so that I can unmute you. Yes, Michael, go ahead. Do you have any question or contribution?
Okay, when they say and in mathematics means plus. So I don't understand why we are subtracting. Sorry, the what the man said. He said we are going to subtract, but in mathematics and means plus.
Yes, I understand that, which was I'm coming. Solomon, I'll get to you. In mathematics, just as I mentioned earlier, and means plus, right? But if we want to look at it in the context of what this one is actually um looking at, right? Sorry, who is that? Solomon.
Yeah, good evening.
Do you have a
Do you have
question
a
or you
question
want to
or you want to? Yes, I still want to comment on the profit after tax and preference dividend.
Mhm.
Yeah, so like Chimamanda, I think Chimamanda is saying, I think it should be profit after tax plus preference dividend because and means addition mathematically. And again, they should say, they should be clear if we are supposed to less that preference dividend. They should say profit after tax less preference dividend. Like in most of the other formulas, if they want us to less to deduct, they will always use the word less. So in
Mhm.
this case, that and should be addition.
Okay,
That's
so
my own contribution.
that's why I said
That's why I
it's
said
better we get
it's
a
better
question
we
that
get.
have that thing so that it will be very, very clear as to whether it's add or deduct. So just give me a minute. Let me look for something on it. I can see Olamilekon. Your hand is raised. You have
Yeah, I think
contributed.
I
yeah,
was
I
the one
think
that
it's
said
just a
before.
contribution to what he said. I think the answer is actually it's actually like explanatory. It's just like saying profit after tax rather than saying profit less tax. So I think what you're talking about is profit after taxation and preference dividend has been removed. It's just like saying profit after taxation and after preference dividend. So that profit that you have after removing the both of them, that's what we're talking about. So it's just basically English context. It's not even mathematics really. It's just profit after tax and after preference dividend has been removed. So you subtract the tax and you subtract the preference dividend, whatever you get is what you have, that profit that you have after the tax and after the preference dividend have been taken. So what you have is what you use.
Okay, thank you for your contribution. Just give me a minute, please. Let me see which other person. Adetunji, go ahead, please.
Yeah, good evening.
Good
Yes,
evening.
just a contribution to what has been said around the profit after taxation and preference dividend. So I also go with I think from the way is stated, profit after taxation and preference shares. So if you look at the term taxation and preference dividend, there's they are somewhat expenses, in the income statement. So they
Yes.
so they will be taken out after from the profit. So for those people that are saying mathematically, okay, if we look at it mathematically in this way, um, plus and minus. So they're saying that after they're saying and means that you plus. Yes, you plus, you add the preference dividend as an expense to only taxation, then the addition of both taxation and preference dividend will be taken from the profits. So
Yeah.
that makes the word profits after tax and preference dividend. So if you are saying mathematically, so that we don't get confused about the about the word after and. So after and is after, you are saying minus times minus equals to plus with that and brackets. So you are saying minus profit minus open brackets tax plus preference dividend close bracket. That's what that sentence means. I
Yeah.
believe you. Yeah, I believe that's the spirit.
Yeah. Thank you very much for your contribution, and thanks to everyone that actually made contribution as well. So just as we've all said, right? When they say and, mathematically and means plus, right? But the first thing that you have to take note of is the after that comes before the and that you're saying, right? This after that comes before the taxation and this other one, right? So what it means, just as we've all said, is your profit after taxation, right? And after you have removed your preference dividends. Now, in order of dividends payments, if we remember clearly, the very first set of people that are usually settled in any situation is mostly the preference dividends, right? And whatever is left is now what the ordinary shareholders, those real owner of the business, would now take out from. So that is just basically what they are still presenting in a way. That means you want to see that actual net profit that will be available to the ordinary shareholders after you have settled every other you have settled the preference shareholders. So that's just basically what they want to look at, because you are coming to invest. If you consider the other ones, it will not really be accurate, right? So that is why you need to use that profit that you have already removed. Let's just say the profit you are using, you have paid your preference dividend, is what is really left for the ordinary and the main shareholders to share or enjoy that you are considering. So that is just like the summary of everything. I hope you're all clear on it. Who even asked that question? Yeah. So thank you all for your contribution. Yeah. So, but I'll still look for a question, Sha. I'll look for a question that has it, so that I'll just, or you guys can look for it and drop it. We'll look at it together. So let's move forward. Hassan, your hand is still raised. Do you have any question?
Yeah, good evening. Good evening, man. Thank you for the class, man. It's just a
Mm-hmm.
kind of contribution.
Okay.
Yeah,
Yeah.
what I think I agree with what Mr. Olariwaju said earlier. This question should not be looked mathematically. I think we should just try to
Yes.
understand. That should be the best this thing. If you are looking at it mathematically, you just get confused. You just
Yes.
get confused. I believe that we should just look at the question itself and then try to understand what the examiners are asking us to do. Thank you, man.
Thank you so much for your contribution. Thank you. That's why we are here. We are all here to learn. So thank you. I appreciate all your contribution. So yeah, let's move forward. So that's it. And they're giving us a little formula or questions to play with. So remember they say we can use average, right? So that means we are going to still take average of this. So we're giving profits before taxation as this, income tax expenses, right? And this is our profit after tax. These are our profits after tax. There's an interest charge on bank loan where this amount, right? Now, so they are now calculating the return on shareholders capital. So what is our profit after tax is 145,000. That one doesn't need any working. So that is why you saw them just brought it down the way it is. And our capital, what's that second one, Steph? Share capital and reserve, right? Since they gave us the opening and the closing, right? Remember they told us we can use the average. So that is why we are taking the average. And to take average, we simply add this plus this and divided by 2. So that was how they got the 850, right? Times 100 for it to be in percentage. So this is the percent. Just as the return on capital employed, 17.6% does not really make any full sense, right? Does not really make any full sense until you are comparing it with something, right? Or you're checking it against something. That is why you'll be able to make more meaning from each of those average, each of those what is it called? Ratio, right? So just as we did with the rows, the next thing is for you to know what to do should you be presented with a group account. So they say when calculating the return on shareholders capital for a group company, the main focus of attention is normally the return on the investment, right, of the shareholders in the parent company, right? So the return should therefore be calculated as profit after taxation and non-controlling interest. Remember the one we did the other time, we added controlling interest to it, right? So but in this case, when they say profit after taxation and not controlling interest, that means the profits you have after you remove your taxation and after you remove those interests, right, that relates to your not controlling interest, abi, or should I say the shares that relates, or equity component that relates to your non-controlling interest, you have to remove it. Because why? The why is here. They said your attention is focused on the parent company. That part that is actually owned by the parent company is what you are looking at. And that is why the non-controlling interest part of it needs to go out. You calculate your return on shareholders for the group, right? Then equity attributable to equity holders, the parent company. That means is the one that relates to the parent company alone that you're going to consider when it's come to group, right? So just take note of those little different. For your return on capital employed, you're still considering your non-controlling interest, right? In your capital employed, right? In your capital employed. But for this one, we are looking at the return on share capital. So you have to remove non-controlling interest to I'm coming. Chimamanda, you just raised your hand. Do you have
Yes,
any question?
yes, ma. Yes, ma. Yeah. The non-controlling interest. You said we should take the one that is concerning the part of the
The
parent company.
parent. Mm.
Okay, thank you.
So that is what they say there. And they mentioned that your attention is basically on the parents. You are just you just want to know the one that belongs to the, like, the main parent, the main owner of that company. That is what you just want to look at. Like the majority shareholders. What is that part, right, that belongs to them? That is what you use to measure the return on shareholders capital. So that is why you have to take out the non-controlling interest part of it for you to get that actual picture of what you're looking for. They say the share capital and reserve should not include non-controlling interest in the equity, right? So that is just see what they are telling you. That means this other part as well, since you have removed the non-controlling interest, it should not be part of this as well, right? Why? Because your focus is on the parents. So that is just it. So, and again, whatever answer you get from here, for you to interpret it very well, try to link it to all those elements that makes up your formula, right? This one has increased an increase or decrease in any of your return on share capital ratio, right? Would likely be, not even likely, will be as a result of increase or decrease of those elements, right? That came together to make up your profit after tax. Same thing applied to your equity part, right? So an increase or decrease in those elements would lead to an increase or decrease in your return on share capital ratio. So that is how you link them together, and that's how you're able to explain it better. So the next one is return on assets, right? That assets that you are using to generate. So sometimes from the name of the ratio you are calculating, you should be able to understand what it is about, right? Return on assets. When we talk of return, anything, if you notice, most of these things that carry return on it, your profits or loss is always the first thing that you see here. Why? Because that is what you use to measure your performance or your return, right? Then assets, return on assets. You are comparing your profits with the assets, right? The asset you are using to generate that profit, that is what you are calculating, right? That is what you want to see, the ratio of your asset against the profit you are making from that asset. So that is just basically what you are looking at. They say the normal convention is to use total assets, right? Which include both current and non-current assets. However, other variations are sometimes used, such as non-current assets only, right? So what I'm just simply saying is that mostly people use what? The total assets. And what's your total assets? The total assets consist of your current assets and non-current assets, right? But they're not telling you that sometimes you can use non-current assets only, depend on what is available, to you, right? Or depend on what you are looking to achieve, right? So basically, just as with other ratio, you're comparing your what? Profit before tax and your assets, right? So by the time you compare your return on assets for year one, year two, whether it's increasing or decreasing, right? You have to compare it with your profit or loss. It will be as a result of those elements that was considered before this was arrived, or either movement in your asset, whether more asset was purchased, right, in a particular year, or there was a lot of disposal, would also lead to an increase or decrease on your return on assets, right? So the next thing now is for us to look at the profitability and asset utilization ratio. I'm coming. Who is that? Lavender.
Yes, ma'am. My question on return on assets, which you just explained,
Mm-hmm.
still and using my company as an instance I work with. So we're a cross-border service payment company that processes payments across African countries. You get? And in our balance sheet, our
Mm-hmm.
non-current assets, which comprises of cash and cash equivalents, consists of users' deposits that is held in trust in our assets account. So are you saying return on assets? Because for our company, this is our major assets, basically, cash and cash equivalent, apart from PPE. So are you saying, because what you explained now from the notes that was in the text, you said basically the return on assets is calculated based on the total of current and non-current assets. So for my company, are you saying that users' funds in trust should be we should calculate net return on assets with the cash and cash equivalents? Because the money is actually not as until a value a service has been rendered for us to determine, okay, or if they withdraw the money back into their account. I don't know if you get me.
Now, before you know which one to use, the very first thing for you to take note of is what return on assets. And why are they calculating return on assets? You're just trying to look at the asset that you are using to generate the revenue, your income that you're making. So the question is, those assets that you are making, you're referring to, are they part of the asset that you use to generate your revenue? That is one question you need to
Yes.
ask. So if it is, then you can add it as part of your assets to use to calculate it, or you can use your non-current assets alone, right? That is why they give you this option.
All right, ma.
Yeah. Let me check. I think there is another question. Or is it contribution? Okay. Or does anyone have any contribution to this before we move forward?
For price eviction.
Hello, ma.
Yes, I can hear you, Hassan.
Okay. Concerning what she just said, now I think I have a little contribution for what I learned recently. She mentioned that there are some revenue that they are here to provide service for. I think that would be best um, treated as IFRS 15 that talks about receiving revenue for what you have the service company share. So that
Mm-hmm.
is, if she can just regard those revenue that are yet to be provided service for as deferred payments. That will be under liability, under current liability. That means
Okay,
she should
Sorry.
just
sorry.
Yeah.
Let me
recognize.
come in here. Let me come in here, Hassan. So
Okay.
when the deposits, when we receive the deposits in the journal entry, we record it as liability because actually it is not our funds, but we receive the
Mm-hmm.
money into an account which is part of our asset, which is cash and cash equivalent. I hope you get it. So actually it is
Okay.
recorded in our liability.
Okay. So
Yeah.
that's what you are saying, Abi. And then it's not part of your asset now.
Okay, all right. I wanted to really be
You know,
clear if
the
that should
money is
be
like
calculated.
it's like a two-way thing, right? It's
Yes,
like a two-way thing. So since it's on your liability side, you've already recognized the liability that, for every transaction, there's always like two legs to it. So
yes,
you recognize the liability part of it. So that one is now showing. So whatever is in your cash and cash equivalent is part of your assets. So to say, you are holding the money. The money is like a liability to you, Abby,
yes, yes.
but you have received it. You have recognized the liability now. Oh,
All right, ma.
Maybe does anyone have like an experience with anything like that? So that we'll move forward. You know what, Lavender? Just reach out to me after the class or probably tomorrow, and would have like further discussion on it so that will not slow down the class.
All right, thank you, ma.
You're welcome. So let's move forward. The next one is your profitability and asset utilization, right? So profitability and asset utilization. They say the size of the return of capital employed or the size of the return on shareholders depends on two factors, right? The profitability of goods and services that the entity has sold and the volume of sales that the entity achieved with the capital and asset it has employed. This is known as asset utilization, right? So that is what would actually that is what I've been explaining. So your return on capital employed is dependent on those two factors. And what is it? Your profitability. That's why I was telling you that your profit before interest and tax, that whatever would lead to an increase or decrease in that profit or profit before or profit after tax are those things that would affect your return on capital employed or your return on shareholders capital. So that is just basically what they are still repeating here. So the next ratio we'll look at is profit sales ratio, right? So just as the name, you are simply comparing your profits to your sales, right? So they say the sales profit ratio is a ratio of the profit that has been achieved for every 1 naira of sales, right? So what I'm just simply saying is that for every 1 naira of sales that you make, what is the profit that you make on that sales, right? If you sell something of 1 naira, what is the profit that you make on that 1 naira? That is just simply what this profit sales ratio is just simply looking at, right? So they say profit sales ratio are commonly used by management to assess financial performance, and a variety of different figures for profits might be used, right? So what it means is that when they say profits, they were not actually specific as to whether you would be using your profits before tax, right, or profit after. So, and that is what they are just telling you here, that you can use different type of topic depend on what you want to achieve or what you are looking at, right? You can decide to use a profit before tax or profit after tax, whichever one is suitable, or whatever you're looking at will determine the one you're going to use. So they say the definition of profits can either be any of the following, and I think I've actually made mention of this. It's just profits, right? Depend on what you want to achieve. You can decide to use your profit before interest and tax. You can decide to use your gross profit, right, or your net profit. That is your profit after tax. So it's dependent on what is it called, what you want to achieve, right? That will determine the one that you'd be using. And this is an example that shows this. For this example, we're given the profit before tax, we have income tax, and we profit after tax. So we can decide to use this one and we can decide to use this one. So dependent on the one that you want to use. So for here, the profit used was the profit before interest and tax, right? And how did they get it? Profit before tax, right? They added the interest to it to get that. So that was what was used. So just as they said, you can just use any profit at all. So you don't really have to give yourself a deck on that one. And whatever you get, you can now use it to compare, right? The two things. So this one, they use the profit before interest. This is what they got, right? And they use the profits um after interest and tax. This was what they get. So depending on what you are looking at, it is what will now determine which of the profits you want to use. They say it is useful to monitor the ratio of different type of costs, right? Of cost to sales. The following ratio can be useful to highlight an unexpected change in period, or to indicate the difference between the company and other company in similar industries, right? So this one is just for you to look at your cost of sales to sales, right? What percentage of your sales is your cost of sales? That's just basically what you are looking at, right? The net administrative cost in comparison with your sales, right? To say that, okay, we're making the sales of 100,000. In this 100,000 sales, what's the percentage of administrative cost, or how much of that sales is going into administrative costs? Whichever one is clear, that's just basically what you're doing. And they can also ask you to calculate the selling and distribution cost in comparison with your sales, just for you to see that, okay, this sales we are making, what percentage of it goes to administrative costs and what percentage of it goes to this or that thing. So these are also other internal ratio that you can use to monitor the flow, right, in your income statement or your performance, depend on what you're looking at. So the next thing is asset turnover ratio. They say the asset turnover ratio is the ratio of sales to capital employed. Ratio of sales to capital employed. It measures the amount of sales achieved during the period for each 1 naira of investments in assets, right? Just as the name implies. You want to know that, okay, for every 1 naira of sales that we made 100,000 naira sales, right? So we will now want to compare it with the amount of investment that was made for every of those 1 naira, right? For every of those 1 naira sales that was achieved, you want to compare the amount of investment that went into ensuring that sales was made. So that is just basically what you are looking at. It is measured as a multiple, right? So many times a year. The asset turnover is also the ratio of sales to assets, right? Minus current liability. This is because capital employed is equals to total assets minus your liability, excluding the long-term liability minus your liability, right? So what they are just saying is your asset turnover ratio is the ratio of sales, right? Your sales, the sales that you make to your assets minus your current liability, basically. So, and this asset minus current liability is simply them showing or you calculating your capital employed, sort of. So that is just it. So this is an example for us to go through, right? To see how many times that you turn over your sales, right? Is usually measured in times. Is usually measured in times and not in percentage, right? So this is just it. This is just it. So you can just go through it so that we'll move forward. We'll move forward. But regardless, all these things you understand it better when we're actually looking at a more comprehensive question. But I don't think we'll be able to do that this night. We'll just come quickly do that one before we dive to another topic in our next class. So the next one is percentage annual growth in sales. This is you just trying to check the amount of growth in your sales, right, across years, right? They say it can be useful to measure the annual growth or decline in sales, measure as a percentage of sales in the previous year. For example, if sales in the year ended were 5.8 and sales in the previous year was 5.5, the annual growth rate has been 300,000, right? Divided by 5.5. And how did they get the 300,000? It's simply you saying this 5.8 minus the 5.5 to see that changes, right? The difference between the sales you made this year and the one in the previous period, right? Divided by your previous period sales for you to know the percentage growth, right? And this is showing us that our sales actually increased by 5.45%. So that is just basically what you use this one to calculate. Again, these are little ratios that you can calculate just to monitor the flow of things, your financials. Now, so the next category of ratio that I'll be looking at is let me check. Do you have any question? Okay. Fikayo, can you pause mute your mic? So the next one is working capital efficiency ratios, right? So now we just have to look at the purpose of working capital and go through all this one before we move to the main ratio itself. So there's a purpose of working capital. Working capital efficiency ratio measures the efficiency with which the entity has managed its receivable. You know that when it comes to capital, working capital, we're talking about all those our current assets, right? Current assets, right? Like receivable, you're talking about both current asset and current liability. Your receivable, your inventory, your trade payable, right? And other current liability. Wumi, can you help us mute your mic? Thank you. Fikayo, I'm coming. Let me see. I'm not able to mute her. Okay, I'll do that. Let me tell the person helping us to manage the class to remove muter. I'll drop a message for him now. So they said the working capital efficiency ratio measures the efficiency with which the entity has managed its receivable, right? So these are the things that make up your working capital. The ratio are usually measured in terms of average number of days, right? Is you trying to measure the average number of days you turn your inventory to sales, measuring the average number of days that it takes you to receive the money that people are owing you, and the average number of days it will take you to pay out those that you are owing. So this is basically what those ratios are going to look at. They say the working capital ratio are a useful measure of whether the entity has too much or little invested in working capital. It's just you trying to look at the flow of things, right, in your working capital and to be able to balance it well. So that's just basically what the working capital ratio helps you to do, right? They said excess investment in working capital. They said excess investment in working capital is indicated by a long cash cycle, right? A long working capital cycle that appears to be getting even longer. When too much is invested in working capital, the return on capital employed will be lower than they should be, right? So you can see how the return on capital employed will be affected by what is it called? The working capital management. So excessive investment in working capital will lead to long term. So what does it mean? By long cash cycle, the mean is it will take you a very long time before you are able to receive money from those that are owing you. So when you calculate your working capital ratio for the previous year and you're calculating the one for this year, now you see that the thing has increased, right? That means your working capital cycle has actually increased, right? So if it takes you longer period of time to recover the money that others are owing you, definitely to some extent it will also take a longer period of time for you to be able to pay those that you are owing, and vice versa. And that would happen as a result of you investing too much in your working capital. Now, the next one is under investment in working capital. They said this is an indication of possible liquidity difficulty, right? When working capital is low in comparison with industry average, this might indicate that current assets are being financed to an extent by current liability, particularly trade payable and bank overdraft, right? So what this means is that, for example, your receivable cycle is actually very long, right? You're not getting money from those that you're supposed to get money for, right? And you don't have enough cash on ground to take care of um your your liability, right? So every activities you are doing is mostly financed by your current liability, right? Mostly financed by your current liability. That means you're largely dependent on the money you're receiving from those those that you are owing, right? You have to owe people or get like external money or buy things on credit in order for you to continue to run that business. So that's just basically what they are saying here. Okay, that was nothing. Okay, they say average time to collect receivable days, right? Or outstanding. So this is like receivable average period. That is what I know this ratio to be before, but I don't know what they are writing here. They say this ratio estimates the time it takes on average, just as the name implies, to collect the payment from customers after the sales has been made. It could be described as an average credit period allowed to customer or average collection period, whichever one is used. But the main thing is it's just for you to know that okay, we sold on credit to this so customer. How many days will it take us for us to get back our money, right? To receive that payment for the goods sold on credit. That is basically what ratio is looking at. And to calculate it, you need what? Your trade receivable, right, for that period, all over your credit sales. So these are the two things that you need. You're comparing trade receivable over your credit sales, right? For you to know that, okay, these sales that I made though, in comparison with my what is it called, receivables, how long will it take me to recover my money? That is basically what you are calculating. They say trade receivable should be the average value of receivable during the year. Of course, this is if you are being given receivable at the beginning and the ending, then you take the average. If what you have is only one receivable, you use it like that. However, the value of receivable at the end is commonly used here. So this is just it. Depend on how the question is presented that will determine. If you are giving beginning and ending, just use the average. And if it's only one that you are being given, just use what they gave you. The sales are usually taken as total sales for the year. However, if the sales are analyzed into credit sales, right, and cash sales, it is probably more appropriate to use the figure for credit sales. So what you're just saying is that it is not all question that will give you credit sales, right? If you did not see anything like credit sales, they didn't differentiate between your total sales and your credit sales. Pick your total sales figure as given in your income statement and use it to carry out your calculation, right? You don't have to crack your brain on that. So that is why they have to make this statement for you to just know that it's not in every question that they'll specify that this amount is credit. This amount of our sales was made on credit, right? So in such situation, use the sales in your income statement. They say the average time to collect money from creditors should not be too long, right? A long average time to collect suggests inefficient collection of amount due to receivable, right? So when you calculate it and you compare them, the amount, the period it will take you to collect should not be too long, right? It should not be too long. That's just basically what they are saying here. Because if the amount of period that it takes you to collect your money back is too long, it will definitely lead to liquidity issue, right? You're just making sales, you're not seeing the money. So that is what it will result to. So the next thing is average time for holding inventory. So we are just basically trying to look at is that inventory that you have in your store or in your warehouse, how long does it take you to turn it into sales, right? How long does it take you to turn it into sales? That is basically what this ratio he's looking at, right? They say the ratio is an estimate of the average time that inventory is held before it is used or sold, right? So that's just basically what you're looking at. And what's the formula? Your inventory. They'll give you your inventory in your SOP all over your cost of sales, right? Why cost of sales? Because any rising cost of sales because any inventory that's either been used, right, or sold, the cost price of it is what you are now going to take in your income statement, right? So that's why you are comparing it with your cost of sales. They say in theory, inventory should be the average value, right? It's still the same thing they are saying here. Should you be given beginning and ending balance, use the average. If what you are being given is only one figure, just as they mentioned here, particularly in exam, use that figure and move forward. Don't look back. So the next thing is average time to pay supplier. So now you have looked at your average time to receive money from those people that are owing you. The next thing is for you to calculate how long it will take you, right, to pay those that you are owing yourself. And the best way to calculate this is to compare your payable and your purchase. Remember, receivable deals with sales, while your payable deals with purchase. It is when you purchase something that you owe somebody, Abby. So that is why the trade payable is being used in comparison with your sales. And again, if you are given beginning and ending figures, you take the average of both. If not, just stick to the only one figure that you are being given. Now, they went further to make this statement that you should take note of. They say when the cost of purchase is not available, the cost of sales should be used instead. That means if you're being given a question and there is no purchase, there is no information with regards purchases, what you should use is what your cost of sales, right? Because that would reflect it. So that is just what they said here, so that you take note of it. So working capital and efficiency ratio now. They have given us one question that we can use to calculate this. Okay. So I've been given one question that we can use to check this, right? And since we have been given beginning and the ending, what it means is that whatever we are picking from here, we are using the average, right? So they say sales in year one total 3,000 and the cost of sales is this 3 million and this 1.8. The working capital efficiency ratio is calculated as follows. Your average collection days is 435 over 3 million. And where is the 435? I'm coming. 435. Yeah, 400,000 plus this. It's just them taking the average of this, average of receivable, average of this, right? And it's the average that is used to divide all over whatever you're using based on the formula. So that's just basically it, right? So based on this, it takes us 52.9 days to what? To collect the money people are owing us and to turn over our, what is it called? Our inventory. It takes us 66 days and it takes us an average of 33 days for us to pay our, what is it called? The people we are owing. So that is just it. I think we'll stop here for today. And from next class we'll pick up from here. We don't have much again. So we'll just quickly wrap it up and look at one question before we move to the next question, the next topic that we'll be taking. So we'll just quickly look at this in our next class before we move forward. So this is where we'll be stopping for today. Because it's late already. Some people are already sleeping. Do you have any question? Any addition, subtraction, contribution? Thank you all for joining this
What
class.
Hello, hello, ma.
Yeah.
what will be our next topic after ratio analysis
I'm
so
actually
that we
not.
can
I'm not sure, but I would pass the message across during the week.
read ahead.
Okay, no problem. Thank you.
Yeah, yeah,
Adetunji, go ahead.
yeah. Thank you for today. Thank you for the
Is there
class. Wait, I was
Thank.
going to ask if you get the source copy of your presentation.
Sorry, what? I didn't get that.
Yeah, I was going to ask if you get the soft copy of your presentation of the
Okay, okay.
slides.
This is actually the new icon pack. I will drop it in the group.
Okay, okay.
It's the
All right,
icon
thanks.
pack that I'm using. This ratio is in chapter 25. That's what I'm using.
Okay. All right, thanks so much. Yeah.
So if you already have the pack, you just check chapter 25. That's where we are.
All right. All right. Thank you.
Thank you all for your contribution and cooperation. See you guys next week, God's willing. Yeah, thank you.
Thank you. Good night.
Good night.